Joining us now to talk all things SpaceX, its IPO, also the general landscape, Peter Singlehurst, head of private companies at Baillie Gifford. And we just know, SpaceX is a really important investment for you guys prior to the offering. Let's start there. What does this, the biggest IPO in history, represent to you and to the firm and to, I guess, support the thesis when you first made the investment way back when?
I think that the SpaceX IPO needs to be seen as the culmination of a trend which has been playing out now for 15 years or longer of companies staying private for longer. And this is something that we started to see in 2012 when we first started investing in private companies. Now, we didn't think that companies would get this big and stay private this long, but here we are with SpaceX going public at something like a $1.8 trillion valuation. That's 900 times larger and more valuable than Tesla was when it went public in 2012. So on the one hand, this is a story of a truly exceptional company which has compounded its growth at a very high rate. On the other hand, it's a story of a bigger structural trend of companies staying private longer and more returns accruing within the high-growth private markets.
And Peter, to that end, when you think about Tesla after it's gone public, it was a volatile ride, but it's 25,000% higher than when it listed. And so will we see a level of returns, do you think, in the public market, or does that have to be in some ways pushed against? Are the meat and bones of returns going to have happened to private investors?
I think mathematically, it's very hard to see how you could see SpaceX delivering the same kind of returns as a public company as Tesla did. But I think what this speaks to is a requirement for investors to have exposure to growth in both the private and the public markets. The world has been set up to almost divide these things and say there's kind of private growth and there's public growth, and these things are different. And we've taken a different approach. We've sort of taken the view that actually if you want to do growth equity investing, you want to do it properly, you have to do it in the private markets and you have to do it in the public markets. And what our clients are, our end beneficiaries, who are predominantly pension funds, what they need and what they ask from us is that we give them exposure to the world's best growth stage companies, starting in the private markets, earning the returns that we can generate there, and then also earning those in the public markets from within our public funds to make sure that they're still capturing that growth even once companies transition into the public markets.
Peter, I think it's important to pose the question, why is SpaceX going public? And when Elon Musk spoke to Jamie Dimon, he eventually got to the answer, which is they need capital for this growth phase. But what we are seeing outside of just this fixation on IPOs is a race for capital through equity. How comfortable do you feel as a firm at Baillie Gifford that whatever mechanism it is, raising money at that volume, but it basically then goes directly into capital expenditure? That's what's happening here.
You want to invest in companies that are able to deploy capital at high rates of return. So I don't think there's anything wrong per se in investing in capital-intensive businesses. And in fact, what you want is a company that can deploy large amounts of capital, but where you can earn high returns on that capital. And ultimately, that's what separates a good business from a bad business. It's return on equity. And so when we're looking at a company, whether it's SpaceX or Anthropic or any other company that we invest in privately or publicly, ultimately what we're asking is how do you get to high returns on equity? And it's building those theses that then leads us to invest in companies. And in the case of SpaceX, increasingly that thesis is going to have to rely on AI. They've shown that they can invest capital at high rates of return in rockets, in Starlink, and of course the next leg of that is going to be in AI data center build out, quite possibly in space.
But that's where it becomes so fascinating, particularly, Peter, for Baillie Gifford, which in the private markets backed SpaceX on a thesis of space, backed Anthropic on a thesis of AI, and now they're all overlapping in terms of business models. What is your perspective of commoditization or a winner takes all, or is there room for all of these giant AI players to be winning in the technology as well as perhaps in the public markets?
I think what your question gets to is this very important question of where does value accrue in the AI stack. Now, hopefully lots of value is going to accrue to the end customers. That has to happen. Historically, we've seen value accruing to the chip manufacturers, initially with NVIDIA, but now increasingly to memory manufacturers. But I think what we're also starting to see is value accrue at the foundational model level. And I suppose with the Grok acquisition, SpaceX is making a bet not just on the foundational model level, but also on the infrastructure level. And I think what we're seeing with the deal that they did recently with Anthropic is that they have options in terms of how they can monetize in the AI transition, both through their own models, but also importantly through the infrastructure itself.
I have so many questions about this. You know, let's be honest. The hedge that SpaceX has put in place in the interim is to become a hyperscaler and sell compute. Played a blinder with that. We got the design, or at least the renderings of orbital data center. I think the team are going to put them up on the screen now in that presentation that Elon Musk made. We're like, there's the body, there's the solar arrays, there's the radiator. Which part of the thesis, Peter, is most important to you, right? It is a long way from the TAM of 26.5 trillion that they're basically packaging it as enterprise AI. And in the interim, this plan for orbital data center, like, it needs to work. That's what they're telling people on the roadshow.
So there's absolutely no question that the orbital data center sort of strategic moves that they're making widens the range of outcomes for SpaceX. On the one hand, if it works, it increases the potential upsides for the business. On the other hand, if this doesn't work, it's going to increase the downside for this company. And investing ultimately is about ranges of outcomes, it's about probabilities, and it's about payoffs in those range of outcomes. What we've seen with SpaceX over the years is that they have continuously tested and validated a series of outlandish hypotheses. The very notion of the business starting off as a private rocket company was itself an outlandish hypothesis that they validated. Then the idea that you could have reusable rockets was also an outlandish hypothesis, and they validated it. They did the same with Starlink, with satellite-based broadband. They've done the same with rockets on the scale of Starship. And the orbital data center play is the next hypothesis that they are seeking to validate. But everybody should be totally aware of the risks that are involved in this. It is unproven. In the event that they prove it, the payoffs will be large. But as we've already touched on, the amount of capital that is going into this means that in the event that they don't validate it, it's going to increase the scope of downside in the investment as well. And investors just need to understand the range of outcomes and the payoffs that go with that.
Can I ask about payoffs, Peter? Because I don't want to go into the granularity of how much SpaceX exposure you have, et cetera, but how long do you think you'll hold it? And how much do you think it's a worry or an anxiety that all these other big public companies are selling equity into this market at the same time? Alphabet trying to fund its own capex in the equity market. Meta might be doing as well. And does that take oxygen out of the room?
I think that's probably part of the thinking that's going on for these different companies trying to raise these large amounts of capital. They're sort of trying to soak up what available capital there is. But to your first question, different funds within Baillie Gifford are going to be in very different positions. For those funds that have owned SpaceX since 2018, since it was a $30 billion company, those funds have very, very large exposures and large positions in SpaceX. Now, it might make sense post-lockup for those funds to start selling down, even if they want to maintain a meaningful exposure, because ultimately we are beholden to our clients, and we have to provide them with a level of diversification within their funds. And then, of course, funds that don't own it, funds that are solely public funds, they then are faced with the question of whether to buy it for their funds. So it might well be that you see different funds within Baillie Gifford doing different things over the coming months, and that will be a function of the history and the portfolio context. I think there's universal agreement that SpaceX has been an exceptional company. The real question from here is, what is the right price, and what is the right position size in SpaceX?